Assalamualikum OyaRahmatullahe OyaBarakatuhu. Welcome to my virtual classroom, MKA Classroom. Now let's start today's video tutorial. We are going to discuss one leverage. Today's topic is leverage. What is leverage? What are the types of leverage? That is the basic discussion. What is leverage? Leverage refers to the effect that fixed costs have on the returns that shareholders earn. Higher leverage generally results in higher but more volatility returns. Leverage means the use of fixed cost to magnify its profitability. Magnify its profitability. That is the mechanism. Lever is the mechanism we use lever to uphold to product. So leverage refers to the effect that the fixed costs have on returns that shareholders earn. By fixed cost, we mean costs that do not rise and fall with the changes in a firm's sales. Firms have to pay this fixed cost whether business conditions are good or bad. This fixed cost may be operating cost, such as the cost incurred by purchasing and operating plant and equipment. That is fixed cost, operating fixed cost. Or they may be financial fixed cost, such as fixed cost on marketing, making debt payments. Generally, leverage magnifies both returns and risks. Generally, leverage magnifies returns and risks. A firm with more leverage may earn higher returns on average than a firm with less leverage, but the returns on the more levered firm will also be more volatility. That means we are going to see you that if the firm has more leverage, it has a chance of more earning profit, as well as this firm has a more chance of risks. Many business risks are out of control of managers, but not the risks associated with leverage. Manager can limit the impact of leverage by adopting strategies that rely more heavily on variable cost than on fixed cost. For example, a basic choice that may firms confront is whether to make their own products or to outsource manufacturing to another firm. In the same way, managers can influence leverage in their decisions about how the company raise money or operate. The amount of leverage in the firm's capital structure The mixture of long-term debt and equity maintained by the firm can significantly affect its value by affecting return and risks. The more debt a firm issues, the higher are its debt repayment costs. Those costs must be paid regardless of how the firm's products are selling, because leverage can have such a large impact on a firm. The financial manager must understand how to measure and evaluate leverage, particularly when making capital structure decision. What is capital structure? The mix of long-term debt and equity maintained by the firm, and it has an effect on its profitability. Now we are going to see the format, income statement format and types of leverage. In here there has the leverage, operating leverage, sales revenue minus cost of goods sold. We get gross profit less operating expenses. We have found earning before interest and taxes, EBIT, less interest. Then we get net profit before taxes, less taxes, net profit after tax, less preferred stock dividends. Then earnings available for common stockholders. Then earning per share, that means earnings available to common stockholders divided by total number of shares. Then we can get the EPS, and these all related to the total leverage. And EBIT, sales to EBIT, it is related to operating leverage. EBIT to EPS, it is related to the financial leverage. We know that leverage are two types, operating leverage and financial leverage. So we know leverage two types, one is financial leverage, another is operating leverage, and the combinations of these two leverage is called total leverage. Operating leverage is the concern with the relationship between the firm's sales revenue and its earning before interest and taxes, EBIT, or operating profit, when consist of operations such as cost of goods sold and operating expenses are largely fixed. Small changes in revenue will lead to much larger in EBIT. Financial leverage is concerned with the relationship between the firm's EBIT and its common stock earning per share. On the income statement, you can see that the deductions taken from EBIT to get EPS include interest, taxes, and preferred dividend. Taxes are clearly variable, rising and falling with the firm's profit, but interest expenses, preferred dividend are usually fixed. When these fixed items are large, that is when the firm has a lot of financial leverage, a small change in EBIT produce large change in EPS. So that is the financial leverage. So operating leverage, we see whenever goods and operating expenses, cost of goods sold are largely fixed, a small change in revenue lead to much larger in EBIT. Now the total leverage. Total leverage combined effect of operating and financial leverage It is concerned with the relationship between firms' sales revenue and EPS.
This all about today. Stay home, stay safe. Assalamualaikum warahmatullahi wabarakatuhu.